Daily Fiscal Pulse for the 28th of July, 2026. We're looking at Tuesday's numbers here, and they're all settled and locked in, so you can take these figures as final. Let's start with what's moving the broader market conversation. There's no clear dominant narrative taking hold right now. The headlines revolving around the divided Fed holding interest rates steady with 3 members voting to hike are obviously shaping price movements. Of course, these themes change quickly. What the flows show us tends to be more reliable than what we hear. The fiscal transfer came in at $5.3 billion. That's not alarming on the surface. What stands out more is what's happening underneath. The 5-day flow has dropped to roughly half of what we've watched over recent weeks. Tax receipts are doing the heavy lifting here, sitting at $3.7 billion. The price action is telling us something consistent. ES futures wrapped the day at 7,466, and that's considerably below the 20-day moving average of 7,536. The broader 20-day range spans 216 points and continues moving lower. So what we're seeing in flows and what we're seeing in price align pretty cleanly. Day-to-day moves matter less than the underlying trend. Government spending on a 5-day basis is running about $4.4 billion daily. Put that against the 20-day average of $11.7 billion per day, and you've got a meaningful deceleration. What this means practically: less cash is circulating through the system, from government to households to eventually the markets. That's tightening financial conditions. The year-over-year picture reinforces this. Spending sits roughly flat at $1,320.9 billion. There's nothing in the annual data suggesting a shift in how much fiscal support is flowing in. If you're thinking about taking on risk here, factor in the fiscal headwind. This environment isn't providing support to markets. The conditions gauge sits at -84. But let's put this in perspective. History shows us this setup repeating plenty of times, and even with thinner liquidity underneath, the S&P has averaged around plus 1.5% over the subsequent month. Price doesn't always move in lockstep with liquidity flows. Markets can and do push higher regardless. That said, check the positioning picture. Margin debt is sitting at the 100th percentile, which is elevated. Historically, that's functioned more as a caution signal than an all clear. How does this shape up for markets going forward? Fiscal flows are tracking below the prior year's pace, which weakens the shock absorber built into the system. When headlines turn supportive, markets can still grind upward, but when risk events materialize, like the no clear dominant narrative scenario, downside momentum can accelerate faster because there's less liquidity underneath supporting the floor. A few calendar items to watch. The 31st of July brings the month-end settlement window, which typically reshapes near-term flows. The next significant Treasury coupon interest payment hits around the 15th of August. Fiscal headwinds are clearly visible in the numbers, though it's possible the tightening pace is starting to level off. The real inflection probably hinges on how these scheduled flows arrive. That's what we're monitoring heading into the next session.